Hi, investors. It's Nick here, and I thought I'd give a quick comment on the interest rate hike and what it means in practical terms, and maybe a little bit of background on giving it some context, I suppose you could say. So, in other words, a bit of good old-fashioned macroeconomics. All right, so it's gone from 1.25 to 1.75, which is a big hike, and typically what happens is that banks jack up interest rates to crush inflation. In other words, if we look at it this way, I'll go to my screen share, we have a lot of money coming into the economy, or had a lot due to COVID, so helicopter money basically, and that money's got to go somewhere, and it goes into people having the money to compete for various things, and thus those things go up in value. Some things are enforced, like inflation with energy costs, and some are kind of semi-voluntary, like inflation with house prices. House price inflation is driven largely by a lack of demand. But as you see here, if we look at house prices, so this is interest rates. I want to talk about that in a second, but as we see with house prices, basically house prices are shooting up and have gone since just after COVID or COVID thereafter. So really odd kind of play out in the system. But I would argue that a lot of this is just down to extra money supply and gets soaked up in various ways. And the rule of thumb is if extra money supply, then assets go up in value. Typically, the money kind of gets soaked into that. So how is this all going to work out? Well, I think that interest rates are probably going to elevate for a while, for a few years, and I think there'll be a big push to try and get inflation down. I don't think interest rates are going to go crazy. The reason I think that very simply is because it's very analogous right now to the 1940s. The war, COVID, supply shocks, the economy reorganizing itself as we go from globalization to deglobalization. In this country, it's especially serious because we have Brexit, which is a real problem, versus the 1970s, which was largely baby boomers getting financially or buying property and buying assets and so on. So there's a huge cohort of people driving up inflation and huge demand. And also the difference between now and way back then is that in the 40s and 50s, there was a lot of government debt. And obviously, if interest rates go up, the cost of government debt increases. So governments have to find money to pay for the interest costs, just like we all do. So what happened was that the debt as a percentage of GDP gradually got washed down, as it were, because of inflation and so on. And in the 1970s, just kind of stabilized. And it's now that we're seeing another hike in this GDP ratio. So the rule is that the higher the debt to GDP ratio, the lower the government will keep interest rates because they don't want to hurt themselves, simply. And if we go back to my chart, my original chart, wherever it's gone to, this one, you can see the correlation is very clear. Now, because GDP is actually quite substantial, so if we look at, for example, debt to GDP, it's nearly 100%. So it's quite high and quite expensive to service this debt. And therefore, the government are going to be reluctant to really push it with interest rate hikes to destroy demand. And therefore, I suspect that they may peak at around 3%, 3.5%. And that's just my guess, but actually there are a lot of economists who believe this as well. People like, Ray Dalio is a hedge fund manager, but he is a very successful one and he has a lot of economists working for him. And that's his prediction, which I kind of buy into. Right, so in a practical day-to-day basis, what does it mean? Well, I think if you are there's an announcement for interest rate hikes, then there is the actual hike, and there's going to be a big surge in demand short term for people trying to lock in mortgage deals before the banks actually increase the rates. So they know that there's a 0.5% in it, and some banks have a lag. And I need to corroborate this with a couple of our mortgage advisors, but essentially it's go time if you want to get that lower fixed rate. Historically, the average is around 4.5% base rate. And I suspect the way it's going to play out now is that we get a surge of inflation, a rise in interest rates, then the economy will be a basket case, then they might drop interest rates again, and then it's this kind of balance between between stimulating the economy enough so that it's not in a complete dead zone, but not overstimulating so that it creates lots of inflation. But the catch is that we're in for lots and lots and lots of inflation for a long time to come. And that'll be largely down to rising cost of food because of rising cost of energy, although saying that oil prices tend to fluctuate a lot, and I know they've come off a little bit. But the long-term story is just, certainly in Europe anyway, cost of energy, especially natural gas, is going to be really expensive. And we're going to have a very expensive winter with high energy costs. Anyway, getting back to the day-to-day market, I think, based on my experience, there's going to be a mad push for people trying to lock in deals now because they know that interest rates have risen and the banks haven't actually locked in their deals. So that'll be that. I think you'll get less people offering on properties. I think properties with compromises will hang around, and I think you'll be able to cut deals on those. But overall, I think the market will kind of remain relatively static. As I said, or I think I said earlier, that it's because with inflation, wages rise, and therefore mortgages are mortgages are tied in with wages because it's X times affordability. So in other words, X times wages. So 4.5 times wages is what you can borrow, and therefore I think people will be more afraid to make offers. They'll be more restrained. There'll be more bank down valuations because the banks will start getting nervous about people overextending. And the easiest way to do this is to simply just say, right, this property is not worth what you have offered on. And I know this because we've had a couple of cases recently, and also agents keep talking to me about down valuations and that we must make sure that we don't even try to renegotiate on down valuation. It's a lot of nonsense because actually in the end it's only set when exchange happens. So everything else is open to negotiation, and it's simply down to whether you want to buy it and they want to sell it. Here's a really important chart which is very predictive, and I've done a whole video on this stuff. But essentially, it's a sentiment index, and this is a leading indicator. In other words, I pay a lot of attention to this because if this starts tanking massively, then I know the market's on its way down. But also, I'm like a canary in the coal mine. I'm talking to the agents all the time, so I kind of have a day-to-day feel on it. And sentiment is declining, and I expect in the next month's release, it happens every month, then it'll be somewhere below 50, somewhere around here, like 40, something like that. And the way the index works is that it's the ratio of up valuation or down valuations to offered prices. So in other words, you have an offer accepted at 200, and then the surveyor says, well, it's only worth 195. That's a down valuation on the offer. And then if you get a lot of that, the index drops heavily. If you get the opposite, then it rises. So in 2020, just after that, as the property market started to reopen, then valuations shot up, and here we have it here. So it's the other pattern you can see is that it tends to hold for a while, for maybe a year and a half or whatever, 2 years, and then you have a drop. Now, this is a change indicator. It's not like a chart like that. It just represents swings in sentiments. It's a bit like the consumer the Consumer Confidence Index, which I will find for you now. And like this one, this is also a swing indicator, and you can see that consumer confidence is really low, and you would expect house prices to drop because that's been a correlation in the past. But the difference is this time round, you don't need that many people competing for a good property for the price to be pushed up. So where does this all go? Well, as I said, I think prices are going to stabilize. I think it's going to be easier for you to get property, nice property. Therefore, that's a good thing. And I generally think it's just going to be easier to work with. The market will be easier to work with. In respect to costs, I suppose you're going to have, if you're foreign national on a limited company buy-to-let mortgage, we're really going to have to be looking at around 6% yield. And that's gross rentable yield, so 6.2, 6.3% net. Gross rentable as in cost of renovation to get the property in a rentable condition. There are quite a lot of these properties around. There will be more of them. I think the previous gameplay was all about capital gain. I think now it's about capital preservation for now and then capital gain for later. And that's why I'm still a huge fan of Manchester as a whole. I think it's a very strong economy, and I think it's relatively robust. And also it's attracting an awful lot of money. So a lot of Hong Kong Chinese are coming in, and you guys, if you're watching, you've got the money and you've got the work ethic, and you're going to add to wherever you choose to live. So I think Manchester's long-term future is good. I think the important thing is just to avoid compromised properties. Make sure that they're in good condition so you don't have to spend too much money on them. Go for around 6% yield, as I've said. Accept that it'll be fairly cash flow neutral for a while. Then the way it pans out is that, I've done a lot of research on this, but the way it pans out, and I'm not going to go into the numbers because it'll just bore you, but the idea, the concept is that rent increases in line with inflation because it's a cost of living. Interest rates are fixed. Therefore, over time, you make more money, relatively speaking. So that's a good thing. So as long as you accept that you're in it for the long term and that you just got to put up with net neutral cash flow for now, then in years to come, the investment will mature nicely and it'll produce much better returns. Also, another really important point to give you a little bit of hope, and it's kind of my investment strategy, my personal one, is that whenever you have high inflation and relatively low interest rates, that the way it goes is that inflation erodes the value of debt. So it means that as long as interest, so I'll give you an example. So let's say you borrow £100,000, £200,000 price of a house. So that £200,000, you've had 10 years, let's say you're cash flow neutral on that. So the rent pays all the bills and you're basically evens on the whole thing. Then you have made, let's say you bought the property a year ago, right? On a fixed interest deal, you've made £20,000. You may ask yourself, how the hell did that happen? Well, because the value of money, the value of that debt, that £200,000 debt has gone down by 10% because inflation has gone up by 10%. And therefore you can only, the purchasing power of that money has declined by £20,000, which is an awful lot. Now the inverse, there's another thing that goes on where you have capital gain and you have erosion of debt, where you get this double whammy. And if you're really well positioned, you can get both. And therefore, on a £200,000 house that went up, say 6% or 5%, we'll say for the sake of round numbers, then effectively you've made £30,000. So your debt is worth £20,000 less, and your property is worth £10,000 more. And as I said, the point about inflation is that rent goes up in line with inflation, generally speaking. So when you look at your investment on two fronts, you go, well, there's the capital gain on the property. I'm making money because property's worth more. But as we know from history, I'll go back here, you get periods of growth and then it flatlines out. So what I expect is we've still got more growth in the tank. And the reason for that is that markets work in cycles, and they have done for 170 years. And we're not over yet. And there's a very interesting economist, Fred Harrison, who talks about this, specializes in the topic. And yeah, just based on historic precedents and so on, I think we've got another couple of years. And I corroborate that by looking at the affordability data. And this is basically mortgage payments as percentage of take-home pay. And generally you get 3 or 4 years of poor affordability, then there's a reset. And we're in year 1. So there's at least another 2 years of this capital gain ahead of us. And then with capital decline, what I find is that in lots of areas around the country, you might get 15, like say, odds are if you buy in an area where the workforce can hang on to their jobs and people who are economically stable want to buy, then you might see a 10 to say 6% to 15% decline nominally. But as I say, we've still got some capital gain left in the tank. And the thing about capital gain is it's always very counterintuitive. And I know this because I've lived through, this will be my 3rd cycle. People just go, well, I don't know why prices are going up, but they're going up. Well, they're going up because of demand, because people who can afford to buy the 3% of houses, of 3% of the housing stock that's up for sale each year, they can afford to compete for that and bid the price up or push the price up. So there it is. I'm broadly optimistic as long as, so for my case, and I can't speak for anyone else, just me, broadly, the reason property investment works for me is erosion of debt. And that's a good thing. So the money that I owe is worth progressively less and less and less and less over time relative to income. So that's a really good thing. And I think there's still some capital gain. And I'm also aware that I'm in it for the long term. And therefore, I'm looking at the 15-year, another 12, 14 years before I get another big cycle of capital gain. I can get the benefit of inflation eroding my debt, which is great, over a long period of time. Then I get capital gain, so I then get double whammy, as it were, and then I'm a happy bunny. So that's the way I look at it. And as I say, for you, if you're a foreign national buyer, I just think if you can be cash flow neutral and you're prepared to wait it out, then it's good. I think it's very dangerous to look at extra high yielding property like 6.57% because the demographics are terrible, generally speaking, and the demographics are everything, because property is basically a people thing. The value of your home, or the house you buy, should I say, is directly correlated to the wealth of the people that want to live in that house. You buy a terrible house in a terrible area that attracts terrible tenants, then the capital value of that house and houses like it in that area will just decline. And there are lots of examples of massive capital decline, like Blackpool and Bradford, for example, for very different reasons, by the way. But the decline will wipe you out financially. So if you sink in, just think of it like that. Your savings are at stake, your gain is at stake. So just being very conscious about where the growth is, where the demographics are good, and accepting that we are going through a plateau period for a while, I reckon, maybe a year. And then I expect another surge and then a crash. And so there it is. I think broadly it's time to get on with it. And the other final thing is that for Hong Kong buyers, of course, your currency is quite strong against the pound. Sorry, your currency is quite strong against the pound, so that means that property is more affordable, and therefore there is a whole argument for either going cash flow neutral and maxing out on your loan, which is a very strong argument, assuming fixed interest rate deals, and let inflation do its magic with eroding the value of debt, or you go lower loan to value, try and get some cash flow, but knowing that the money that you've put in is buying you relatively more real estate in this country than it was a year ago or 2 years ago, whatever. So there are choices, but overall, it's disruptive. It's difficult for an awful lot of people, but for you as investors and for me, I think it just softens the market up a little bit and makes it much easier to get deals. So there it is. I hope that's helpful. Thank you.